Hello and welcome to this session in which we will discuss involuntary bankruptcy petition for Chapter 7 and Chapter 11. In the prior session, we looked at the voluntary petition. What is voluntary versus involuntary? Involuntary is when someone forces you into bankruptcy. Voluntary is when the debtor themselves, the person that owes the money, decide to seek relief through Chapter 7 or Chapter 11. Now, bear in mind, whether it's Chapter 7 or Chapter 11, there is no need to show insolvency. You just need to show that you cannot make the payment or you can't make the payment. And remember what we talked about earlier, when it's voluntary, sometimes Chapter 7 might be dismissed. So you want to be familiar with voluntary petition. In this session, we would look at involuntary bankruptcy. Here, in this situation, the unsecured creditors. Why unsecured? Because the secured creditors, they have collateral. They can get their collateral and they can make whole. Unsecured creditor can force a debtor, they can force you into bankruptcy proceeding. If they cannot collect from you, if you cannot pay them, if they don't have a surety, if they don't have security, what else do they have? They will force you into bankruptcy to liquidate, and they will get something out of that, or they hope they will get something. Remember, unsecured creditors are those who are not backed by any collateral. They have the right to file involuntary bankruptcy. They have to be unsecured. They can force you into this bankruptcy through Chapter 7 or Chapter 11, through liquidation or through reorganization. And this is what we will discuss in this session. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Criteria for involuntary petition. So to successfully initiate an involuntary bankruptcy, creditor must demonstrate that the debtor simply is not paying their debt as they come due. Simply put, we're asking you for the payment, you're not paying. This is a sign of financial distress and forms the basis for what? For forcing the debtor to go into bankruptcy proceeding. No need to show insolvency. What is insolvency? Insolvency is when your liabilities are greater than your assets. You don't have to show this. Actually, the creditor don't know whether you are insolvent or not. All what they know is they're not receiving their payment, and as a result, they want to force you into a bankruptcy. Now, bear in mind, farmers and not-for-profit charitable contribution are exempt from involuntary bankruptcy petition. Simply put, you cannot force them into bankruptcy. Creditor cannot force these entities into bankruptcy against their will. Now, can anyone force you into an involuntary bankruptcy? We have to know the rules here. To file an involuntary bankruptcy, creditor or creditors must collectively be owed at least $18,600. And you know, every time there's a number, this number could change in a year or two. So you might be watching this recording a few years from now, and the number most likely will increase, will be around the 20,000. So they have to, in total, owed at least 18,600. Remember, and unsecured and undisputed. It means that's you're not disputing this debt. Again, unsecured refer to debt or obligation not backed by any collateral. Why? Again, I'm going to keep repeating why, because the people, the creditors with collateral, they're going to get their asset, they're going to get their collateral, therefore they are secured. They cannot force you into a bankruptcy. Now, the amount has to be 18,600 at least in total. It could be one or many. The least is this amount. However, when you have number of creditors, you have to look at how many creditors you have. If you have less than 12 creditors, if one individual have at least 18,600, they can force you into a bankruptcy. Now, if there are 12, what they have to do, if none of them get 18,600, they can, guess what? They can sign it together. But at least one, as long as they can get 18,600, they can force you. If not individual, one person get 18,600, well, they can like bundled together. If you have 12 or more creditors, if that's the case, you need at least 3 creditors. 1, 2, 3. 3 individuals to sign the petition, and those 3 individuals in total, they have to have 18,600. Maybe one of them got 18,600, but that individual will have to convince other 2 individuals to sign the petition. If it's less than 12, you just need 1 individual signing and a total amount of 18,600. Let's take a look at an example. The debtor is Emma, who has not been paying her debt. She has 6 creditors. John owes 16,000. Lisa is owed 3,000. Mark is owed 4,000. Rachel is owed 1,000. Tom is owed 2,000. And Maggie is owed 24,000 in secured debt. Well, here's what you have to know. We can't count Maggie as part of filing the involuntary bankruptcy. Why? Because Maggie's debt is secured. Therefore, Maggie, she can't even file. Therefore, when they are looking to file, they cannot ask Maggie to sign. If she signs, it's not going to help them. Therefore, we have these 5 individuals. Guess what's going to happen? Since Emma has fewer than 12, an involuntary bankruptcy petition could be filed by any or more creditors whose combined claims must meet this number, 18,600 threshold, and this number could change. Well, let's take a look at them. Can John by himself file? No. Can John with Lisa file? Yes. Can John with Mark file? Yes. Can John with Rachel file? No, because John and Rachel is up to 17,000. So definitely, if they want to file bankruptcy, the first thing is John will have to be involved in this, because even if the remainder, the 3,000, the 4,000, the 2,000, and the 1,000, that will not equal to that. So John plus either Lisa, John plus either Mark, John plus Rachel and Tom will work. So John, being owed 16,000, cannot file alone because his claim is less than 18,600, but they can team up, as I showed you, and as long as they team up, and John has to be a member of this team up, sometimes you might have to have more than 1 member. The point is, the total has to be the total unsecured creditor, 18,600. Since this is less than 12, if only 1 individual has it, will do. Otherwise, they have to team up. Once the order of relief in a bankruptcy is established, which is the beginning of the bankruptcy, the creditors have 20 to 40 days to do what? To meet. And they meet, and the meeting is called Section 341 meeting. The Section 341 meeting, known as the creditors meeting. Simply put, the creditors meet. It takes place 20 to 40 days following the issuance of the order for relief. What's the order of relief? Remember, we talked about this in the prior session. It's the official date of the bankruptcy starting date. This meeting is a mandatory event where all interested parties, who are the creditors, the bankruptcy trustee, and the debtor. Now, the creditors are the creditors. The bankruptcy trustee is the person that the court assigns. Could be a lawyer, a judge, a financial person, just a person that's going to oversee this process, and the debtor are required to be present. They must receive proper notification for the meeting, and the purpose of the meeting is for the creditor and the trustee to question the debtor about their financial situation and the bankruptcy filing. It's an essential part of the bankruptcy process, this meeting, providing an opportunity for direct communication between the debtors and the creditors. Now, once the bankruptcy starts, the bankruptcy establishes an estate, and this trustee is in charge of the estate. It's basically the individual, in a sense, like an estate. They create basically a fictitious entity called bankruptcy estate. In the bankruptcy cases, the bankruptcy estate refers to the collection of assets that are available to pay off the debtor. So simply put, we create this estate, and in this estate, we put all the assets of the individual, of the debtor. Why? Because we're going to take those assets, sell them, get the money, and pay off the creditor in a certain order. But we need to know what goes into this box. What assets are included in this estate? Well, obviously the asset of the debtor. What could be the asset of the debtor? They could have a real asset. They could have personal asset. They could have real, like land, building, personal asset, cars, furniture, jewelry, motorcycle, boat. They will become part of this asset. Also, income from estate property. Any income generated from the estate property within 180 days after filing for bankruptcy is included in the estate. So what could be included in that estate? Remember, you could have also stocks in this, bonds in this. What do stocks pay? Stocks pay dividend. So when the stock pays dividend, the dividend goes back into this box. Bonds pay interest. It goes back into this box. If they have building where they rent the building, the rent income goes into this box. So any income generated from that property that's inside the estate itself is part of the estate. Also, if the debtor receives certain types of property within 180 days after filing the petition, this too will be included. What could be the case? What are we looking for? Let's assume this individual went through a divorce and they got a settlement. They went through a divorce and they receive a home, $50,000 in settlement, a car. Well, guess what? Anything in that divorce settlement goes into this box where they have the assets. If they receive an inheritance, if the rich uncle, rich aunt, rich grandpa, rich grandma passed away and they gave them money within 180 days after the filing, that money goes here. If they receive any insurance proceeds of any type, it goes here. So we need to go what goes into the bankruptcy estate, and we need to know what does not go into the bankruptcy estate. So we'll see that on the next slide. How about leases and property right? The bankruptcy trustee who manages the bankruptcy has the option to assume and retain any leases the debtor has, assign them to someone else, or if they're not worth it, it's too much headache, they might reject them entirely. So it's a judgment. What is not included in this bankruptcy estate? Well, any income the debtor earns after filing for bankruptcy. That's not part of it. Remember, the individual is going to be working. They're going to be earning W-2 wages or some sort of a work. The work that they perform, the money that they earned money, not unearned. Unearned is interest, dividend from stocks, interest from bonds. Those are unearned. Any earned money is not included because the individuals still need to live. This means money earned from work and other sources working following the filing is not accessible to creditors through the bankruptcy process. You don't put this money inside that estate. You need to know what's in that estate. W-2 money, work money is not. Also, we have to let the individual keep basic necessities to live. Like what? Clothing, medical devices, essential items for them to live. Each individual might be unique. They might have some medical equipment that are valuable, but they need those. So those are not put in the estate. These items are considered necessary for the debtor daily life and well-being, and therefore protected from being used to pay off creditors. Now remember, we talked about the trustee, and I said the trustee could be a CPA, could be a lawyer, could be a former judge, a current judge, someone that the court assigns to oversee the process. So in a bankruptcy proceeding, the trustee is giving the status of hypothetical lien creditor from the moment the bankruptcy petition is filed. Hold on a second. How can a trustee becomes a creditor? Well, the trustee, they're going to spend time to organize this process. Therefore, they need to be paid. Therefore, they become technically a creditor because they're working for this process. They're working for everyone. They're working for the debtor. They're working for the creditor to resolve this issue. Well, as a result, the earnings, the compensation, they become, because they're going to be incurring expenses, it becomes a hypothetical lien. Basically, they become a creditor. Now, the trustee is treated as if they have a lien on all debtor's property as of the filing date. And this gives the trustee priority over other creditors, except he cannot or she cannot be in front of people with perfected security interests. Remember, we talked about attachment and perfection. He cannot be or she cannot be in front of them. You remember those. Existing statutory or judicial liens. Any of those liens, also they have priority over the trustee. Nevertheless, she's going to have priority over unsecured creditors. Also, the trustee has authority over fraudulent transfers. The trustee has the power to invalidate, basically reverse fraudulent transfer. We talked about fraudulent transfer, fraudulent conveyances. We're going to look at them again here, made within 2 years before the filing date. So a transfer is considered fraudulent if it was done with the intention to hinder, delay, or defraud creditors, or the debtor made the transfer without receiving reasonable equivalent value in return, especially when insolvent. What are we talking about here? When someone's going to go into a bankruptcy and they know this, they might know this 6 months ahead, a year ahead, they know that their situation is desperate. What will they start to do? They will start to give stuff, whatever they have, to their relatives, to their friends. Why? To hide it away. So they don't want, remember we had created this box called the estate for the bankruptcy. They don't want those assets to go into this estate because they're going to have to sell and give it to creditors. So they will try to get rid of these assets by selling them at low value in a fictitious transaction with a side agreement that I will buy it from you later or keep it for me. Well, the trustee can invalidate all these transfers. Suppose a debtor who's insolvent means their liabilities are greater than their assets, transfer a valuable painting worth $10,000 to a relative for $1,000, just 1 month before filing bankruptcy. And this debtor says, I sold it. Well, the transaction will be challenged and potentially reversed by the trustee as a fraudulent transfer. And there are two reasons for this. One, the debtor was insolvent at the time of the transfer. If you're insolvent, why would you do such a thing? Two, the painting was sold for much less than its true value, indicating an intent to move assets away from the reach of creditors. Now, if they sold it for $10,000 or $9,500 or $10,500 or something in the ballpark of $10,000, well, then it's fine. You just made a sale. You're trying to cash your assets, maybe to pay other expenses. But the fact you sold it for much less, it will be considered a fraudulent conveyance or a fraudulent transfer. There's a presumption here. It is presumed, it's assumed that the debtor was insolvent during the 90 days preceding the file of the bankruptcy petition. What's insolvency? Liabilities greater than assets. Under this presumption, under this assumption, any preferential transfer. What is preferential transfer? What do we mean by preferential transfer? For a payment to be considered a preferential transfer, the creditor must have received more than they would have if they waited for the bankruptcy distribution. Then we have what's called preference. So the debtor is given some sort of a preference. However, payment made to secured creditors, any payment made to secured creditors are not considered preference. Why? Because these creditors would have received the collateral or the payment in full under the bankruptcy regardless, because that's why they are secured. So you don't have what's called preferential transfer to a secured creditor, because if you're paying them off, obviously you're not going to pay them more than their balance, and that balance is secured by an asset. It's the same thing. They're going to get it anyway. So the preferential treatment is usually with unsecured creditors. In a bankruptcy proceeding, the trustee has the authority to reverse certain payment known as preferences. Why? Because we want to make sure that no creditors gets undue advantage if they were paid preferentially at the expense of others. What does that mean? This process would involve looking at transaction, at payment that the creditor made before the bankruptcy filing. Now, how far do we have to go back? Well, it all depends. If the transaction is considered fraudulent, we'll go back 2 years. If the transaction is to a creditor, we'll go back 90 days. If the transaction is considered to an inside party, which is a relative or a friend or a partner or a shareholder in the corporation, we'll go back 1 year. Let's take a look at these preferential transfers. Transfer made for the benefit of a creditor. Basically, you are paying one particular creditor. You're doing a favoritism. You're choosing that creditor to pay them more than others. Payment toward a pre-existing debt of a debtor. So you are paying or making prepayment, make an extra payment for debt that already existed. You know it's going to go into bankruptcy. If you're going into a bankruptcy, why are you paying this? Payment made within 90 days before the bankruptcy was filed. Again, those are all reviewed. Or within 1 year if the creditor is an insider, officer of the debtor company, a partner, or close relative. And this, if the transfer involved fraud, the trustee could go back 2 years if they suspect that. Transaction made while the debtor was insolvent, especially when you sell something below fair market value. Now, simply put, situation where the payment allowed the creditor to receive more than they would under the standard bankruptcy procedures is considered preference. So what's a preference if you want a definition for it? The creditor would receive a payment. They would not have received this payment if they waited for the standard bankruptcy procedures. Therefore, they received some sort of a preference. What can the trustee do? Well, the trustee can reverse the payment. If the transaction meets these criteria, the trustee can set aside the preference. This means the payment are taken back from the creditor and added to the bankruptcy estate. Again, the idea here is to make sure fair and equitable treatment of all creditors by preventing one creditor from receiving an advantage over others just before the bankruptcy filing. Also, when we say transfer, yes, usually you transfer money, but you could also transfer rights. Also, in bankruptcy law, the concept of transfer is broadly defined and include various types of transactions. Like what? There's a broad definition. It's not limited to just payment and money or the handing over of property. It also includes granting a security interest in the property. So what you do is, right before the bankruptcy, you decide to grant security interest to one of the creditors. Why? You want to give them priority. Well, that's a preference. That's a transfer, form of a transfer and a preferential treatment. Suppose Max owes money to a supplier, Jane. Just before filing for bankruptcy, Max grants Jane a security interest in his store's inventory, which Jane then perfected it. Now what happened is Jane jumped into the line to the front. And you're going to see why that's important. Well, we talked about attachment and perfection, but we're going to see shortly in the next recording, when we distribute the money, well, Jane will have a preference, will have a priority here. This action can be considered a preference because it is a transfer made for a pre-existing debt, giving Jane a secured position over other creditors. We also have to differentiate between antecedent debt versus contemporaneous exchange. What does that mean? A payment is considered a preference only if the debt already existed. That we're talking about here, antecedent debt. So if you pay someone and the debt already existed, well, why are you paying them now? You don't have the money. Why are you paying this creditor specifically? However, when we're looking at a current exchange for new value, that's not a preference. For example, Emily, a business owner, owes her landlord, Tom, back rent. Okay? Days before filing for bankruptcy, she pays off her overdue rent. This payment is a preference, as it settled an antecedent debt. Versus, if Emily orders supplies for her business from a vendor and pays them immediately upon delivery, just before filing for bankruptcy, this is not a preference. For one thing, she's getting money and exchanging the money for some other asset. Since the payment is for new value received at the same time, that's not a preference. What's also not a preferential transfer is payment made in the ordinary business activities are not considered preferential transfer. For example, if you have to pay for supplies, if the debtor pay for ordinary business activities, routine transaction, you need to pay your bills, well, that's not preferential transfer. So non-preference transfer is if a business, just before filing for bankruptcy, make a regular payment to a supplier for a recent delivery, this is the ordinary course of business and not a preference. However, if the same business repays a loan to a relative which was not part of the regular business activity within 90 days before filing for bankruptcy, this could be considered a preferential transfer. And for a relative, it could be up to 1 year. The law presumes insolvency before bankruptcy. Now, bear in mind, although that's the case, not all payment made during this period are preferential. Regular business transactions are okay, are typically exempt. Focusing on unusual or preferential payment that might unfairly benefit one creditor over the other, this will be a preferential transfer, and it will be what? Reversed by the trustee. You also need to be familiar with bankruptcy proceeding. What we have a claim. What's a claim? Refers to the right to payment from debtor's estate covering all debt owed. So you have to have a claim. You have to have a claim. You have to file for that claim. If you're an unsecured creditor, you need to file to prove a claim. So basically, you want to say, look, I'm here, I'm unsecured creditor. If you're a shareholder, you must also file for proof of interest in your right. Basically, you have to show that you're a shareholder. Now, if the claim is uncontested claim, uncontested filed claim or interest are automatically allowed. Simply put, if no one contested your claim, guess what? You'll get your funds, you'll get your money. Now, failure to file. For unsecured creditors, if you don't file on time, guess what? You forfeit estate distribution, right? And you can no longer ask for that money. Remember, if you did not file, now if you are not aware of the situation because the debtor did not list you, that's a different story. But if you did not do it, that's your problem. And bear in mind that secured creditor with perfect security interests, right to the specific property, don't need to file a proof to claim and maintain of these rights because by default, they perfected their security interest in this asset. Few things you want to know about the role of the trustee. Remember, the trustee is the person that administers the bankruptcy procedures. They collect all the assets, they liquidate them, they sell them, and they distribute the money. And we're going to see next how they distribute the money. But the trustee can also serve as a professional, like a tax preparer, accountant, or a lawyer for the estate, as long as the court don't disapprove, as long as they don't think there's a conflict of interest here. They would also receive compensation for these professional services in addition to their standard trustee compensation. Remember, the trustee play a central role in this process and can undertake additional professional role for the estate. I mean, the trustee is the person that runs the whole show between the debtors and the creditors. And this could be a long process, complicated process. Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following is not included in the bankruptcy estate? You remember we have this box, and the trustee put all the assets in this box, all sorts of assets. Which asset is not included? Okay, the debtor's personal property at the time of the filing. Yes, personal property will be included. Income earned by the debtor after the filing petition. So the debtor is working and they earned income after they file the petition. Do they have to put this income in this box? I would say no, but let's hold on that. I would say B is a good answer. Let's look at C. Property received from an inheritance within 180 days. Oh yes, it goes into this box, into that estate. Interest from bonds that are part of the estate received within 180 days. Also the interest goes in here. Just like the bonds are here, and the interest within 180 days goes here. So indeed, it looks like B, income earned from the debtor after filing the petition, will not be included. Remember, the debtor, think about it this way, they need to live, they have to work, that money doesn't go in the estate. What should you do now? You want to go to Farhat Lectures, look at additional MCQs that's going to help you understand this topic better. Chapter 7, Chapter 11, they are tested on the CPA exam. Farhat Lectures can help you. I have AI CPA questions, practice questions that's going to help you prepare better for the exam. Study hard, good luck, and of course, stay safe.